Hey everyone, I'm Jeremy Saffron. This is Kitco News. We are back in the studio. Don't forget to hit that subscribe button for the latest. Well, it's a new all-time highs on the gold front. Spot currently trading at around 2460 US. Look at that chart. Now, according to CME Watch Fed tool, the market sees a 93.5% chance of a rate cut in September, which could further boost gold prices. Now, of course, copper back in headlines after a significant run up last year and a continued run. Copper prices have seen a slight pullback, but remain strong. Now, most analysts bullish as the fundamentals for this metal remains high, with the green transition slowly taking place quicker and quicker. Our next guest knows a thing or two about it. He's the CEO of Metalla Royalty. The company is very diversified. Let's welcome back Brett Heath. Hey, man. Welcome back to the show.
Thanks for having me.
Good to have you in the studio this time. Lots to get to, Brett. Let's start with the price of gold. I mean, sitting here at the 2450 mark. You and I were chatting briefly. Last time I saw you at PDAC, we were seeing those all-time highs. It almost seemed like everyone was talking about it, but yet this time around, narrative just a little bit quieter.
Mm-hmm.
What are your thoughts here?
Well, we still see very significant demand from central banks.
Yeah.
And we're going to be getting out the central bank purchase Q2 numbers, hopefully probably around the end of this month. So it'll be very interesting to what we see from that perspective. Mm. You know, we're seeing the retail part of the market and also the institutions even not step in yet, which is surprising. We're just starting to see some inflows just in this last week into GLD. Mm-hmm. Still nothing on the equities, but the central banks are the drivers. Yeah. And I think they're going to continue to be the drivers. And it's pretty incredible to see this type of price action when very, very few investors are in this trade. And what it tells me is that I think it's going to go, again, a lot higher, probably a lot farther than what anyone is anticipating. But when you look at the big buyers out of the central banks, because you got to kind of take a step back and see, okay, well, what is really happening here? Right. And you look at the emerging markets. You know, most of the major emerging markets, the BRICS and so forth, their percentage of gold holdings as of their total reserves, most of them are less than 10%. Some of them are less than 5%. When you look at the US, Germany, France, Italy, the percentage of gold holdings as total reserves is like over 60%. Mm. So, you know, what we've seen, I believe, is we've seen a very significant change in trend where we are getting a lot of US Treasuries as a percentage of foreign reserves coming down. We're seeing that quite significantly across most of the emerging markets. And we're seeing that diversify go into gold. And that is a very, very big amount of demand that's coming into the market. And as I just noted, it's a long ways to go until that normalizes. So I think we can continue to see this for some time.
Yeah, it almost seems like the fundamentals are just stronger here. I mean, you referred to the central banks. We know that China at least announced that they kind of paused for a couple of months. You know, commodities are cyclical. We saw some of the retail audience get spooked by that. But it doesn't seem like it's going anywhere. I guess my question is, institutions aren't yet involved. Do you think that they just find that they've missed the trade at these prices? Like, well, when are they going to start waking up?
It's a tough question. Yeah. It's a tough question. I mean, at some point they will. Yeah. I think we've experienced enough cycles in this market to understand, like, at some point they will. Yeah. I think that there has been a lot of other distractions within the general stock markets. Obviously, there was a huge AI boom. There was an enormous amount of capital that was sucked up into 7 companies that basically were supporting the entire S&P 500. It's, you know, one of the 7 companies represented approximately 30% of the S&P, which is, you know, basically a record going back to like the peak of the tech bubble and many, many decades before that. Yeah. And so when you get markets that are held up, capital is so concentrated into these parts, then you got to watch the flows. Mm-hmm. And that's really the key, because you can look at the fundamentals of different businesses, but we don't live and operate really in a free market anymore. Yeah. You've got, you know, the Fed really doing all kinds of different things. You know, the market hangs on every single word that comes out. And there's a lot of expectations that are built in. So you get when things happen, like for example, inflation comes down tiny little bit, the Fed rhetoric changes a tiny little bit to potentially we may get a cut. And what happens with inflation down, usually, you'd think that, okay, well, gold's an inflation hedge, gold's going to come down. But no, everyone thinks that they're going to cut now, the probability. And we talked about this back in March when the market was pricing in, I think it was like 8 cuts or so for this year. And when we were looking at the data, we're saying, okay, well, look, the Fed is going to have a very difficult time to cut into rising a number of different economic indicators to do that. And so, our position was always like, okay, well, maybe we see 1 or 2. I think we still probably get that. But, I think on the back of that, we probably will see continued or an upturn in inflation. We're already seeing some of the kind of forward-looking indicators turn up. And so, I think that any cuts that we do get will be short-lived.
Right. Yeah, like I said, the market cutting, pricing in at least 1. We've talked to other analysts thinking that they might have to get even a little bit more aggressive. Whether or not they cut, this might be a positive for gold prices. Any surprises here? And I guess my next question is this $2,400 mark where it seemed to be matching resistance, it seems to be the new normal. What does that do for the miners?
Well, it does a lot for the miners. Yeah, I mean the margins for the miners. I think we will see very, very significant quarters coming up over the next kind of 1, 2, 3 quarters, especially if gold maintains at these levels. You get these big moves up in gold, and the costs always follow, but it takes a little bit of time for those to kind of fully follow. So I think we're going to see some very healthy margins within the big producers. And obviously the big royalty companies. I think they're going to have some great quarters in the kind of back half of this year, and even Q2. And most of them are going to be reporting next week.
Yeah, it's interesting that you say that because much like monetary policy, these types of price actions on the gold prices don't hit the balance sheet of the companies for quite some time. So you think that we're just going to start seeing that now? And if we do, is the retail audience going to start paying attention?
That's a tough question because if you would have asked me back in March at almost $2,500 gold, would we have the retail back in this trade and speculating and institutions coming back and large pools of capital like pension funds coming back in, and we just have not seen it. I was looking at the fund flows for the GDXJ, which is the largest gold mining equity ETF, and in the last 5 days, there was approximately around $40 million of outflows. Wow. Like in the face of breaking out to all-time highs, which that was last week. But and same with when I look at it over 30 days, when I look at it over 3 months, both the GDXJ and the GDX have had significant outflows. In fact, the GDX over the last 3 months has had over $1 billion of outflows. So it's not lining up, and I think we're starting to see that turn right now. When you look at the flows, like it's too early to tell, but it looks like there's some rotation starting to happen, and primarily out of big tech, which there are trillions of dollars in there. Now, where that goes, we'll kind of wait and see. It looks like some is heading into gold, not so much gold equities. Like I said, we've had this divergence of gold moving higher and the holdings of GLD, which is one of the largest gold ETFs, physical gold ETF, not equities, that continue to go down. And that's the first time we saw this divergence since the ETF was created, almost a little less than 20 years ago. So it was really interesting to see because we've never seen that. We've never seen that type of divergence before. But just in the last week, we saw the holdings start to go up, and it was pretty significant. I think it was $900 million range of inflows on the GLD. So it could be the beginning of that rotation. Now, if we do get that rotation on the back of the central bank purchases and continued purchasing by central banks, which they have a very significant amount of foreign reserves that they need to, and it's not like they're going to be selling all of it, but if they go from holding 5% to 15% of their foreign reserves in gold it's going to make a very significant difference. And so, I do think that this will continue, not to say that we might not get a couple violent pullbacks, and we've seen that already on this move where, gold's down $75 in a day, but it's just continuing to come back. It's been so resilient. And when you look at that in any type of sector, you can see it's just that's where the real capital is flowing. Again, we haven't even seen it come in from the public yet. Right. So when the public starts to kind of wake up and it adds fuel to that fire, I mean, I think we easily can see, 2,600 to even up to 3,000 this year.
Yeah, it's an interesting one. That's why I wonder if some just feel that they've missed the trade. At these levels, it's like, oh, I should have been picking up, at 15, 16, 1,700 as we continue to talk about. Okay, well, Brett, let's talk a little bit about copper. I mean, you remain bullish, obviously, and know a thing or two about that metal. I know that, Metalla has some interesting holdings too. We just came from Boca Raton. We had Robert Friedland on the stage talking about how big this market is with the energy transition, but yet the fundamentals in the narrative seem to be getting lost. So talk to me about the copper space a little bit.
Well, copper is a very interesting type of setup that we've seen. Obviously, Robert has built a whole business around it, has done a lot of research around it, and he puts out some great work. But I mean, generally, what we have is a shift in the economy, how the economy is going to be run. Every single couple years, there is another new material kind of demand use for copper. Right. And as I think we continue over the next 2, 3, 4, 5, 10 years, that's going to continue. And so we're in a position, the market's in a position today where these mines, there's 20, 30 year lead times from discovery to production on these things. So the actual supply is very inelastic. On top of that, there's a well documented supply deficit that's going to extend through the mid 2030s. Right. So we have this setup where we're going to have an explosion of demand. We've got, most of the copper that we get today is from mines that started producing back in the 1950s and 60s. Like, it's crazy. And the grades are getting smaller and smaller and smaller. And these mines just cannot keep up with, with demand. Now, a lot of that was kind of filled with scrap recently, but that tends to only last a pretty short period of time until kind of most of that makes its way through the system. And then I think as we get into 2025, 2026, 2027, we're really going to see that scenario play out. And it was a very similar setup back in the early 2000s. And at that time, copper was sub $1. And, when these commodities start to move, the price is very, is inelastic to the demand. So it can grow. I mean, we could see copper multiples higher than where it is. Yeah. We're not pricing that into anything, obviously. But the transaction that we did last year with merging with Nova Royalty gave us exposure to 5 of the largest 10 development assets in the Americas, which these mines go for, most of them have reserves for over 30 years. Most of these mines, as they go in production, will produce for, I think the average major copper mine produces for around 75 years. So these are long-term bets. These are long-term, very kind of calculated bets, but there's so few of these great assets that it's very difficult to get exposure to, and there's no way to force additional supply like you can with oil.
Yeah, exactly. You can't just put some new rigs on the ground there. Yeah. Okay, talk to me a little bit about then what the opportunity is here. Much like anything we're looking at as a long-term play, you sitting at the helm of a royalty company gives you, a very different perspective than we get at home. What are you looking at? I mean, it seems like it's the year of M&A. You're going to be targeting some. Are you running, those types of due diligence reports at these levels? What are you looking at?
Well, as part of our strategy, we kind of anticipated this. We really built our business for this commodity cycle that is basically just starting today. And so when we grew our company over the last 8 years, we focused on development assets. And that was, I would say, not the most popular thing to do. The market today and the investors that are primarily left in the resource sector are very short-term oriented. Yeah. They can't see more than a foot or two in front of their face. They're only concerned about next quarter. And in this business, if you want to build a really great company, you have to have a long-term view. And the key always comes down to the quality of the assets. And so when we bought all of these, we have 102 royalties. We actually just put out our inaugural asset handbook. So you can download that from our website, and it goes through all of the different assets that we've bought. And when you kind of go through all these different assets, you'll see that by buying all these things and buying them when gold was at 1,200, 1,300, all the way up to about 1,800 is when we bought most of these assets. All of them are just starting to come online today. We just had a royalty that just started production on an asset called Tocantinzinho that's operated by G Mining. We're expecting potentially 2 more mines to start production in the second half of this year and a couple more in 2025. So we are in a really strong position to not have to basically run numbers at $2,400, $2,500 gold, because it is very, very expensive. Yeah. And the really high quality assets that remain out there drive really high valuations. And I'd say that those are even few and far between. Like, we're seeing a lot of more marginal type of assets. There's actually the most amount of marginal assets I've almost ever seen that are available, but they're still pretty marginal type of assets. And so the really high quality ones, those seem to continue to drive very high valuations. And at these prices, it's even more significant.
Yeah, as well as I know, when you start talking to resource investors, people that have been investing in the commodities, much like us, it's a tiring game. Yeah, a lot of people are exhausted. They're saying, okay, gold is at all-time highs. The equity prices they haven't caught up. What it sounds like you're saying is stay tuned. Those numbers are just starting to hit the books now. It seems like the trajectory, at least the runway this year, might be a more positive one for miners than it has been in previous quarters.
I think it will be. Yeah. I think it will be. And, it's too difficult to kind of put at what price gold's going to have to go up to bring investors back. But that being said, these are turning into healthy businesses. And there's still a lot of value out there. Like I said, the largest ETFs in the mining equities, on the backdrop of gold breaking out to all-time highs, have experienced very significant outflows. Yeah. And it's not to say that there aren't, very kind of select companies that are doing very well. There are a lot of companies that are doing very well, but the big picture is, what's going on with the macro flows of the sector, and they're still going out, at least in the mining equities. So I think when we see these next couple of quarters, the big companies, I think they need to really take charge and put up some great quarters. Yeah. And as more capital comes into those companies, then you'll start to get that to filter down to the rest of the sector. But it's exciting. Yeah. The gold price is in a very strong uptrend right now.
Yeah, we'll be watching it closely, and we have a technical segment tomorrow, so we'll be charting it out. Brett Heath, the CEO of Metalla, thanks for joining us today in studio.
Thanks for having me.
I appreciate the time as always. I'm Jeremy Saffron. For all of us here at Kitco News, thank you for watching. Don't forget to hit that subscribe button. Now we're going to have lots of great content coming up this week and next. We'll see you soon.